Imagine an investor standing at the edge of a decision. Much like the merchants who once stood at the docks, watching ships disappear beyond the horizon, carrying capital they might never see again. The tools have changed. Ledgers have been replaced by screens. Speed has increased beyond imagination. Yet the underlying tension remains identical. Every investment is still an act of faith, disciplined by calculation. Those who deny either misunderstand both. Markets do not reward blind belief, nor do they reward perfect foresight. They reward the willingness to act under uncertainty while remaining solvent long enough for time to exert its quiet authority. Many modern investors believe complexity is new, that volatility is unprecedented, that uncertainty belongs uniquely to this era. But uncertainty has always been the condition under which capital moves. What has changed is the velocity of narrative. Judgment now forms and dissolves in moments, compressing years of reflection into minutes. This compression distorts perception. Temporary conditions appear permanent. Noise disguises itself as signal. In my time, speculation traveled at the speed of rumor. In yours, it travels at the speed of light. The effect is the same, only faster, and therefore more dangerous. Those who survive markets are not those who react the quickest. They are those who understand what does not change. Human behavior does not change. Incentives do not change. The desire to avoid loss remains stronger than the desire to gain. This asymmetry governs markets more reliably than any model. When prices rise, confidence follows. When confidence rises, caution fades. Capital moves not because risk has vanished, but because it has been forgotten. This forgetting is the seed of every cycle. You will hear countless explanations for booms and busts. Beneath them all lies a simple pattern. Excess confidence followed by sudden recognition. The disciplined investor structures decisions so that recognition does not coincide with ruin. This is not pessimism. It is preparation. Preparation is the quiet advantage of those who endure. In periods of abundance, restraint appears foolish. In periods of contraction, restraint reveals itself as foresight. Capital does not reward brilliance nearly as often as it rewards survival. The first task of an investor is not to grow wealth. It is to preserve the ability to remain invested. Time is the only compounding mechanism that cannot be replaced. Lose time, and no strategy will recover it. Diversification is often misunderstood. It is believed to exist to smooth returns. In truth, it exists to prevent catastrophic ignorance. No individual, regardless of intelligence, possesses sufficient knowledge to predict all outcomes. Diversification admits this reality. Concentration denies it. There are moments when concentration is justified. But those moments require understanding rather than conviction. Conviction without understanding is speculation dressed as confidence. Markets do not punish error. They punish stubbornness. The ability to revise beliefs is more valuable than the ability to defend them. Yet revision must be disciplined. Constant reaction is not adaptation. It is surrender to volatility. The investor must learn to distinguish between signal and disturbance, between structural change and cyclical movement. This distinction cannot be automated. It requires judgment shaped by experience and humility. Humility is not the absence of belief. It is the recognition of limits. Those who deny limits inevitably encounter them at the worst possible moment. Debt magnifies this encounter. Used productively, debt accelerates growth. Used defensively, it accelerates collapse. Leverage is not a strategy. It is an amplifier. It increases exposure to both success and failure without improving decision quality. In stable periods, leverage feels intelligent. Stability breeds complacency. Complacency invites leverage. Leverage concentrates risk. When conditions change, concentrated risk demands liquidation. Liquidation compresses prices. Prices validate fear. Fear spreads faster than confidence ever did. This sequence repeats because it is rooted in incentive, not ignorance. Systems that reward short-term performance encourage behaviors that weaken long-term resilience. This is not a moral failure. It is a structural one. Investors who understand structure outperform those who argue intention. Markets are not designed to be fair. They are designed to allocate. Fairness emerges only when institutions restrain excess and protect participation. Without these restraints, allocation becomes extraction. Extraction enriches a few temporarily and impoverishes many permanently. Such systems cannot sustain trust. Without trust, capital withdraws or demands compensation through higher returns. Higher returns increase costs. Increased costs reduce productivity. Reduced productivity invites intervention. Intervention often targets symptoms rather than causes, introducing further distortion. A spiral is not ideological. It is mechanical. Time horizon remains the dividing line. Short-term actors extract value from volatility. Long-term investors create value through commitment. Both exist. Confusing one for the other destabilizes systems. Liquidity is valuable. Liquidity without commitment weakens formation. Markets require builders as much as traders. Builders require patience. Patience is not passive. It is disciplined endurance. The willingness to tolerate periods of underperformance without abandoning process. Compounding does not announce itself. It reveals itself only in retrospect. Those who interrupt it rarely recognize what they forfeited until it is recoverable. Narratives celebrate decisive action. They ignore disciplined inaction. Yet in markets, inaction is often the highest form of decision-making. Knowing when not to allocate capital is as important as knowing where to deploy it. Opportunity cost applies not only to capital invested, but to capital preserved. Preserved capital retains optionality. Optionality is an economic advantage invisible to those fully committed. The ability to wait is power. The ability to refuse unfavorable terms is strength. These advantages are built quietly, without applause. Markets reward those who do not require constant validation. Volatility tests this resolve. Price movements create emotional pressure. Screens magnify urgency. Urgency compresses thought. Compressed thought produces error. The disciplined investor creates distance between stimulus and response. Rules serve this function, not to constrain opportunity, but to constrain impulse. Impulse is expensive. Structure is protective. Over long horizons, structure outperforms intuition. Intuition is episodic. Structure compounds. Those who endure markets long enough learn this lesson repeatedly, usually after paying for it. Capital preservation is not defensive. It is foundational. Growth without preservation is temporary. Wealth without resilience is fragile. The investor who understands this does not chase permanence. He prepares for change. Change is not the enemy of capital. Unpreparedness is. There is a temptation, especially in modern markets, to believe that information itself creates advantage. Screens overflow with data. Indicators multiply. Commentary never sleeps. Yet information alone does not produce insight. Excess information often obscures what matters most. Knowledge without hierarchy becomes noise. Investors confuse activity with understanding. Movement with progress. Markets do not reward those who know the most facts. They reward those who know which facts matter and which can be ignored. In every era, participants believe they are better informed than those who came before them. This belief is comforting and dangerous. It fosters overconfidence, the quiet partner of loss. True advantage lies not in access to information, but in the ability to contextualize it within incentives, constraints, and time. Time remains the most misunderstood variable in investment. Many treat it as a neutral backdrop. It is not. Time magnifies both discipline and error. Decisions made under pressure reveal structure. Decisions made repeatedly reveal character. Markets test character relentlessly, rewarding consistency and punishing contradiction. An investor who changes philosophy with each cycle forfeits the benefits of compounding belief. Compounding applies not only to capital but to process. A sound process, repeated patiently, produces outcomes that appear extraordinary only because few endure long enough to witness them. Endurance is difficult because markets exploit human psychology. Gains feel temporary. Losses feel permanent. This asymmetry distorts behavior. Investors sell what is temporarily impaired and hold what is structurally declining. They seek comfort where clarity is needed, certainty where humility would serve better. This pattern is ancient. It persists because incentives reward short-term emotional relief over long-term rationality. Those who resist this impulse do not rely on willpower alone. They design systems that reduce the need for willpower. Allocation frameworks, rebalancing rules, margins of safety, predefined exit conditions. These exist to protect the investor from himself. The most dangerous narrative in markets is the belief that one has finally understood them. Markets punish understanding unaccompanied by respect. Respect is demonstrated through position sizing, diversification, and acceptance of uncertainty. Certainty is expensive. It demands concentration. Concentration amplifies error. The investor who insists on certainty eventually encounters a reality unwilling to comply. At that moment, leverage reveals its cost. Debt transforms error into obligation. Obligation removes choice. Choice is the core of resilience. Without choice, capital becomes reactive. Reactive capital is forced capital. Forced capital liquidates at unfavorable terms. This liquidation rarely remains isolated. It spreads through interconnected positions, creating cascades that appear sudden but are built slowly through shared assumptions. Markets rarely collapse because of surprise. They collapse because of consensus. When too many investors share the same expectation, fragility accumulates beneath apparent stability. Stability itself becomes the signal. Low volatility encourages risk-taking. Risk-taking compresses spreads. Compressed spreads justify leverage. Leverage creates sensitivity. Sensitivity amplifies shocks. This sequence repeats because it is rewarded until it is punished. Punishment arrives without warning, but not without cause. Investors who study history recognize this rhythm. Those who believe history is irrelevant repeat it. Every generation claims novelty. Every generation encounters limits. Limits are not failures. They are boundaries. Sustainable investment respects boundaries. It does not attempt to eliminate cycles. It survives them intact. Survival allows participation in recovery. Recovery is where compounding resumes. Missing recovery is more damaging than enduring decline. Yet many investors exit precisely when recovery becomes probable. Exhausted by volatility. Convinced permanence has shifted. Markets exploit exhaustion. They reward those who conserve energy. Conserving energy requires accepting that discomfort is unavoidable. The investor's task is not to eliminate discomfort. It is to prevent discomfort from dictating action. Emotional neutrality is not achieved through indifference. It is achieved through preparation. Preparation transforms surprise into inconvenience. Inconvenience can be endured. Surprise cannot. This distinction defines resilience. Institutions play a critical role in shaping this environment. When rules are stable, investors plan. When rules change unpredictably, investors hedge. Hedging increases cost. Increased cost reduces productive investment. Reduced productivity slows growth. Slower growth invites intervention. Intervention often targets symptoms rather than causes, introducing further distortion. This cycle is not ideological. It is procedural. Investors who recognize procedural decay adjust exposure accordingly. They shorten horizons. Increase liquidity. Demand higher returns. These adjustments are rational responses to uncertainty. Policymakers often misinterpret them as malice or greed. In reality, they are signals. Ignoring signals does not eliminate them. It amplifies their consequences. The most effective economic systems listen to capital without surrendering to it. They preserve competition, protect property, enforce contracts, restrain arbitrary interference. These functions are unglamorous, but essential. Without them, markets fragment into short-term extraction. Extraction enriches quickly and collapses quietly. Investors who profit from extraction often mistake timing for skill. Skill endures across cycles. Timing does not. Over long horizons, value creation outperforms value capture. Value creation requires patience, reinvestment, tolerance for delayed gratification. These traits are unfashionable. Markets celebrate decisiveness, speed, confidence. Yet wealth accumulates through repetition, not drama. The absence of drama is a competitive advantage. It reduces error, lowers transaction cost, preserves focus. Many investors sabotage themselves by seeking excitement. Excitement is expensive. Boredom is efficient. Boredom indicates process functioning as intended. The disciplined investor accepts boredom as confirmation, not failure. He understands that extraordinary outcomes emerge from ordinary actions sustained over time. This understanding inoculates against narrative temptation. Narratives simplify complexity. They provide meaning where uncertainty exists. Markets do not require meaning. They require alignment. Alignment between price and value, between risk and return, between horizon and objective. When alignment breaks, opportunity emerges. Opportunity does not announce itself as certainty. It appears as discomfort. Assets become unpopular. Prices detach from fundamentals. Narratives turn hostile. The patient investor observes rather than reacts. He evaluates cash flows, balance sheets, incentives, durability. He does not ask whether sentiment will improve tomorrow. He asks whether value exists today. This orientation separates investment from speculation. Speculation seeks agreement. Investment seeks misalignment. Agreement inflates prices. Misalignment creates margin of safety. Margin of safety is not pessimism. It is respect for uncertainty. Respect allows endurance. Endurance enables compounding. This chain cannot be shortened. Attempts to accelerate it introduce fragility. Fragility eventually asserts itself. Capital markets are unforgiving of fragility. They exploit it ruthlessly, not by malice, by mechanism. Those who survive understand this in personality. They do not take losses as moral judgment, or gains as validation. They treat outcomes as feedback. Feedback informs adjustment. Adjustment sustains relevance. Relevance preserves opportunity. Opportunity rewards patience. Innovation matters, but adoption matters more. Many ideas fail not because they are wrong, but because they are early or poorly scaled. Capital bridges this gap. Capital allocation determines which ideas survive. Investors who understand diffusion, network effects, and incremental adoption outperform those who chase novelty for its own sake. Novelty attracts attention. Adoption creates cash flow. Cash flow sustains valuation. Valuation without cash flow is narrative. Narratives expire. Cash flows compound. The investor's task is not to predict invention. It is to recognize when invention becomes infrastructure. Infrastructure is boring. Infrastructure is reliable. Infrastructure compounds quietly. Those who identify it early benefit disproportionately, not because they predicted the future, but because they understood incentives. Incentives determine behavior. Behavior determines outcomes. This principle endures across centuries. Markets are not puzzles to be solved once. They are environments to be navigated continuously. Navigation requires orientation. Orientation comes from principles, not predictions. Principles endure volatility. Predictions amplify it. The investor grounded in principle outlasts those anchored to forecasts. Forecasts fail. Principles adapt. Adaptation is survival. Survival is the prerequisite of wealth. When I observe modern investors, I see not a lack of intelligence, but a surplus of urgency. Urgency compresses judgment. Markets do not reward urgency. They reward preparedness. Preparedness appears passive from the outside. It looks like waiting, restraint, repetition. Yet beneath this calm surface lies constant evaluation. The patient investor is never idle. He is measuring, comparing, updating probabilities, refusing to confuse motion with progress. Decisiveness without clarity is merely speed toward error. Competence is selective, acting rarely, and with conviction. Conviction, however, is not stubbornness. It is alignment between evidence, valuation, and risk tolerance. When alignment fades, conviction dissolves. Loyalty to process replaces loyalty to position. Investors lose not because they are wrong, but because they remain wrong longer than their capital allows. Capital is finite. Opportunities are infinite. Preserving capital preserves optionality. Optionality allows participation when conditions improve. Forced sellers create opportunity, but opportunity is only valuable to those prepared to absorb it. Preparation requires liquidity, discipline, psychological readiness. Liquidity is not cowardice. It is insurance. Insurance feels unnecessary until it becomes essential. Markets periodically remind participants of this truth. Excess leverage, compressed risk premiums, narrative-driven valuations. These precede correction with remarkable consistency. Investors who deny this pattern repeat it. Those who accept it adapt exposure. Adaptation does not eliminate loss. It limits ruin. Limiting ruin is success. Avoiding ruin allows compounding to operate. Compounding is subtle. It rewards endurance over brilliance. Over time, endurance outpaces innovation. This is uncomfortable in the culture that celebrates disruption. Disruption attracts attention. Stability accumulates wealth. The investor who understands this distinction seeks businesses quietly performing essential functions. Their advantage lies not in novelty, but in necessity. Necessity creates pricing power. Pricing power protects margins. Protected margins stabilize cash flow. Stable cash flow supports valuation. Valuation grounded in cash flow endures volatility. Volatility frightens those focused on price. It barely registers for those focused on ownership. Ownership is a mindset. Shifting perspective from fluctuation to participation. Owners ask different questions. How value is created. How it is defended. How it is distributed. They care about governance, incentives, capital allocation. They understand management decisions compound over time. Markets forgive dramatic errors. They punish consistent mediocrity. Investors should do the same. Forgive volatility. Punish misalignment. Self-awareness is an underappreciated investment skill. Knowing one's limits prevents overreach. Overreach destroys more wealth than ignorance. Confidence grows fastest during favorable conditions. Favorable conditions mask fragility. Fragility accumulates quietly. When it reveals itself, confidence evaporates. Diversification exists not to dilute returns, but to dilute error. Error is inevitable. Diluting it preserves survival. Survival enables learning. Learning improves judgment. Judgment improves allocation. Allocation compounds wealth. This sequence is slow. It cannot be rushed. Markets remember discipline longer than brilliance. The investor who internalizes this truth need not predict the future. He need only remain solvent, attentive, patient, aligning with forces larger than himself. Forces that reward consistency, humility, time. Time exposes fragility, and rewards resilience. Those who respect it prosper quietly. Those who defy it make noise briefly. The choice is constant. Most will choose excitement. A few will choose endurance. Endurance wins.